It's about to get a lot more expensive for Chinese EV makers in Europe. Also, if Occidental is good enough for Warren Buffett, should it be good enough for you?
This is InvestTalk. Independent thinking, shared success.
Good afternoon, everybody, and welcome back to InvestTalk. My name is Luke Guerrero, and today is Wednesday, June 26th, 2024. We have a very exciting show planned for you today. A lot of topics that I found pretty interesting, a lot of market-moving news potentially on the horizon, but most importantly, your finance and investment questions, be it your YouTube comments, your iTunes review questions, voicemails that you've left on our 24/7 voice bank, or hopefully at some time over these next 50 minutes or so, your live calls at 888-99-CHART. With that being said, we'll go over what happened in the market today, as well as some of those show topics we'll run down after we answer our first caller question now.
Hey, Justin and Luke, this is Rob from Connecticut calling, asking about Occidental Petroleum. Come down a little bit recently, and I'm a holder for the past couple of years, and I'm just wondering if this might be a decent time to pick some more up, depending on if and when things start to cycle a little bit away from the AI conversation, and people start looking into other sectors for the first time a little bit. And I'm wondering what your thoughts are on that. Thanks.
So Occidental, OXY is the ticker, is a oil company. And first off, I want to say, yes, it is typically the best time to get into other industries when everybody is talking about something else, right? That's typically when you're going to get your best entry prices into things that are currently being ignored. And so Occidental Petroleum has kind of been in the news recently because Warren Buffett is I think the largest owner of this name. Berkshire Hathaway is the largest owner of this name. Let's take a look. Yeah, they own about 28.79% of the total shares outstanding. 60% of shares outstanding is owned by institutions. And so over the past 10 days or so, Berkshire has bought more and more shares. So it's been top of mind for a lot of investors. Now, interestingly enough, Occidental Petroleum hasn't really had the performance year to date as some of these other oil companies. Here's Exxon right here. You can see on my screen up 14% year to date, whereas Oxy is only up about 5.2%. Now, what I like about this name is that back in 2019, they finished their acquisition of, what was the name of that? Andarco, I think, Andarco. And what that did is it bolstered its presence in the Permian Basin, but at the same time, they had to take on a lot of debt for that acquisition. But take a look down here. Look at this total debt to total equity ratio right here. Back in 2019, 116%, 116, right? So that means that they had 116% debt relative to their equity, up to 200 in 2020. And they've been paying it down year over year. So their total debt has gone from 40 billion in 2019 down to 20 billion, almost in half, in a pretty short period of time. And so they used all that cash flow and all that windfall of cash in 2021 and 2022 to pay down some of that debt, which we certainly do like. Now, another thing about this name is that it does have an interest in carbon capture. So when you talk about globally, oil demand is supposed to peak in 2030. And then as we shift more and more towards renewables, it'll certainly still be a part of the economy, is what I believe, but it should taper off from there. So companies that have invested in renewable energy that are ready for a transition beyond 2030 are certainly ones that you should be interested in, certainly ones that I'm interested in. And so I think they're positioned with their carbon capture investments, and they're positioned with really fulfilling some demand in oil over the next decade or so with that acquisition in the Permian Basin. I think that they are pretty uniquely positioned relative to some other oil companies. They're $60 billion oil company, so large, but not one of the largest, or rather not the largest. Either way, I think that anytime Warren Buffett buys something, it's a reason to pay attention. I think Oxy, like a lot of energy names, are going to do well in the next 4 to 6 months. So yeah, I have no problem with you continuing to hold on to Occidental. I don't know what your position is. I don't know if you should buy more right now, just because there's been a little bit of a run up recently in the wake of the news about Warren Buffett's acquisitions, but still keep it on your watch list. No reason to trim. Thanks for the call. Now, we've got a lot of ground to cover in the next 45 minutes or so. So here is some of what we have for you, time permitting. My main focus point today concerns this headline, and that's that the EU has slapped steep tariffs on Chinese EVs. So how's that going to impact Tesla? The European Union announced a significant increase in tariffs on Chinese-made electric vehicles, with hikes of up to 38%. 38%. This move will have far-reaching implications for the entire EV market in Europe as automakers from various regions adjust their strategies to adapt to the new trade landscape. While Tesla's China-produced vehicles will be directly impacted by these higher import duties, the consequences extend beyond just one company. Automakers from China, the US, Europe, and other parts of the world will need to reevaluate pricing, production, supply chain strategies in order to remain competitive in the European market. So we'll talk about Chinese EVs, Tesla, talk about tariffs and how they've played a larger role in the past 5 years. Really past decade, actually. Can't believe it's already 2024. The past decade than they had in quite some time. We'll also take a look at about how companies have been able to slash borrowing costs and effectively give themselves 2 rate cuts. What do I mean by that? We'll get into that a little bit later on. We'll also talk about U.S. home sales. New home sales slumping, though supply is reaching a high that it hasn't seen in 16 years. And also, should we have time at the end of the show, I'm going to talk about maybe not necessarily a good thing for investors, but certainly an interesting thing. And that is that Interactive Brokers is launching a yes or no contract where essentially you can bet on economic releases, climate events, all sorts of interesting things. Really, what does it say about where investing has gone? I think it says an interesting thing. We'll talk about that at the end of the show. We also have many questions to answer. One from our voice bank on AEIS, a follow-up to a question I got a couple weeks ago on advanced energy industries, and one on bonds and treasuries. We also have some questions that came into our YouTube comment section that we'll be getting to. And of course, we welcome your finance and investment questions now or anytime, really anytime, any day at 888-99-CHART. Now we're going to do a short break, and on the other side, we'll talk about today's market activity. Please remember, you can call anytime and leave your questions on the InvestTalk voice bank, 888-99-CHART. Do you want Let's talk a little bit about the market today. U.S. equities ending mostly higher. The Dow up 4 basis points. The S&P 500 up 16 basis points. The NASDAQ tech names up 50 basis points. And the Russell 2000 down 21 basis points, diverging from large caps. It was a fairly quiet trading day. Not much really going on. Followed mixed performances yesterday that saw the S&P and NASDAQ snap their 3-day losing streaks. Another day of big tech strength. Amazon, notable gainer. Nvidia really left behind from where the rest of tech was. The equal weight S&P lagged yet again. Outperformers included household durables, telecoms, lithium. Underperformers looks like airlines didn't do too well. Healthcare distributors, food, auto parts. Dollar was up 40 basis points. Gold finished down 80 basis points. Crude oil nearly flat at finishing up 10 basis points. And so overall, I think stocks looked pretty directionless with the exception of big tech. I think the biggest focus was more on individual corporate results. Bond yields looked higher to me as Australia followed Canada yesterday in delivering a hotter than expected inflation print. And the big news in terms of economic news was May new home sales, which missed, though the prior 3 months saw big upward revisions. And the month supply continued to increase. We'll talk a bit about that later on. Fed released bank stress test results after the close today, but haven't had a chance to look at that. So certainly we'll be talking about that later in the week. And Thursday evening's presidential debate, as well as Friday morning's release of core CPI, are really the macro highlights for the rest of the week, the rest of the month, the rest of the quarter, and the first half of 2024. All right, let's shift gears and get back to the InvestTalk voice bank. This question came in a little bit earlier.
Hello, this is Daniel from Tennessee. I had a follow-up question to the stock Atlas Energy Solutions. This is one that a caller inquired about on June 21st, the June 21st show. Ticker symbol is AESI. After that show, I was doing some research and looking at the stock, and it looks like it has a couple of different moats going for it in the fracking industry. But then I saw that its shares outstanding has gone up pretty significantly, and I was wondering if that would make it a value trap, or if there are if there are good reasons for a company to issue more shares. Maybe it's not always a bad thing, but just kind of looking for your advice there. For example, I saw in March 2023 they had roughly 57 million shares, and now March of 2024 they're at 104 million shares. So would just like to learn more from you guys on that topic. Thank you.
Yeah, so the question was about Atlas Energy Solutions. And I remember when this call came in, for those of you who don't remember, Atlas Energy Solutions, ticker AESI, is a company that I think is uniquely positioned to assert itself with what has been a growing trend within the United States, and that is moving towards energy independence through the use of fracking. And so I mentioned that should the U.S. continue to want to be atop oil production, as it has been since either 2018 or 2019, companies like Atlas are the way to do it. Now, excuse me, I do remember looking and seeing some interesting shares outstanding data, and it raises a little bit of a flag for me, but obviously when we hear your caller questions, we have not as much time as we would like to go in depth, right? And so when I see something like this, my first instinct is data issue, right? It shows that shares outstanding, for those of you who are watching at home, I pulled up a chart on FactSet, which shows Atlas Energy Solutions shares outstanding going back to the beginning of 2021. And what you can't see if you're not watching on YouTube is that shares outstanding were 100 million. Then it dipped down to 50 million, and then back up to 100 million, then back down to 50 million, back up to 100 million, then to 110 million. And so when I see something like this, what I am seeing and would look into more is this a data issue? Is there something weird going on with shares outstanding? My intuition here is that this is just a data issue. And so I want to answer the question from a broader perspective. And that is issuing shares bad? The short answer there is depends. What we don't like to see is serial issuer of shares, right? Because I can't remember who said it, but there's a quote one time about we're fine with volatility. What we care about is capital destruction. And there are several ways to destroy the capital that you've given a company. One is to run the business so poorly that it goes bankrupt. That's certainly the top answer for how to destroy capital. Another is to dilute you out of existence. So that means that when the company issues shares, you hold a lower percentage than you did before the share issuance. Now, we talked the other day about the difference between issuances and stock splits. Stock splits are on paper, nothing changes. Issuances, you will get diluted unless you buy a proportionate number of shares of the new issuance. But it's not always bad, right? Equity and debt are two ways that you can capitalize a business. And so we don't want to demonize anybody that issues shares. What we want to demonize is serial issuers of shares, biotech companies that burn through the cash on hand that they have and then take more money from investors, diluting their existing shareholders just to set more piles of money on fire, right? Anytime the stock price of GameStop runs up, what do? They issue shares. Now, they haven't found out a way to actually turn a profit. It seems to me like now their best business model is to just invest that cash that they've been raising. But it's important to denote, again, a lot of things that happen within corporate finance can happen for good reasons, can happen for bad reasons. The situation matters. Issuing shares is fine. Issuing shares all the time and diluting your investors is destroying capital. Now I'm ready to take your finance and investment questions, and I will, coming up, with some that were recorded on our 24/7 voice bank and a couple more questions from our InvestTalk YouTube comment section.
Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
So let's shift gears and move towards our main focus point today, which concerns the headline that the EU has slapped steep tariffs on Chinese EVs. So how will that impact Tesla, other electric vehicle companies, and really the electric vehicle transition more broadly? And so the European Union has announced pretty significant tariff hikes on Chinese-made battery electric vehicles, impacting both Chinese manufacturers like BYD and foreign automakers, such as Tesla, foreign to them, domestic to us. And the reason why they're affected is because all of those companies export Chinese-made EVs to Europe. Now, starting in July, the EU will add tariffs of up to 38.1% to the existing 10% duties on all of these vehicles. And this move comes after the European Commission found that the Chinese battery electric vehicle sector benefits from substantial state subsidies and threatens the economic stability of EU-based EV producers. Now, specific tariffs have been set for major manufacturers. So BYD, for example, specifically is going to face 17.4%. Geely Zeekr will incur a 20% tariff, and the state-owned SAIC will be hit with the highest tariff of 38.1%. It's important to note automakers that are cooperating with the EU investigation will face a standard duty of only 21%. If you don't cooperate, well, you're going to get punished with a 38.1% tariff. So where does Tesla come into play? Well, Tesla, which exports its Model 3 and some Model Y vehicles from its Shanghai facility to Europe, might be able to negotiate an individually calculated duty rate in the definitive stage of the tariffs after a substantiated request. And to me, this is pretty all interestingly timed, as Tesla is considering whether to shift its European production primarily from where its Model 3s are made actually in Berlin to avoid the excess capacity in Shanghai. And so the tariffs primarily target battery electric vehicles and actually don't affect plug-in hybrids, which could benefit BYD as they also export plug-in hybrids to Europe. And so, I think other Chinese EV makers like NIO and Xpeng, they also sell vehicles in Europe but don't have EU-based factories, could see long-term sales in Europe constrained by the high cost of building new factories and substantial tariffs. You saw it in the US, right? A lot of this is not protectionist so much in trying to force consumers to buy domestic products, but really trying to not wash out European companies by having cheap goods flooded on their markets. And now a vote by EU nations on the tariffs is scheduled for November 2nd, and the decision requires the backing of 11 more EU nations to overturn the European Commission's ruling. But I think that that's probably unlikely to happen. Why? Well, this also comes at the same time that the Biden administration has raised its tariffs on Chinese EVs to 100%. And so these new tariffs really underscore the ongoing geopolitical tensions surrounding trade, technology transfer between China and the West, and could be a hindrance to more widespread, affordable adoption of EVs. Also, if you read between the lines, perhaps the increased production costs, the increased supply chain costs, and a lot of companies having to figure out how to get their products to market should provide you with even more hesitation when you think about adding electric vehicle companies to your investment portfolios. Now, I hope you know, and we love to remind you, that our audio podcast is now available in video form on our YouTube channel. Just go over and search InvestTalk. And don't forget, that's InvestTalk with 2 T's. And it seems like we're getting some people to watch out there. They like seeing our charts. They maybe like seeing our faces, though I doubt it. It's probably just the charts. But from time to time, they leave investment questions. And so this question is about NXST. It says, a while back, you guys said you purchased NXST. I think next year's earnings forecast is dragging the stock down, but it looks like 5-year earnings forecasts are growing rapidly. Do you guys still own this? And are you seeing the same thing moving forward? So let's start with Nexstar Media Group, and it's a television broadcasting and digital media company. Now, year to date, it's actually flat, down 1 basis point on the day, so that's pretty much flat. And while I pull something else up on my other screen, its revenue growth has been pretty consistent over the past 5 years, with the exception of the dip from 2022 to 2023, right? We had in 2018, 2.7 billion in revenue, and that's kind of grown at about an annual clip of 12% year over year. Now, net income has decreased, which is certainly not something we like to see, but with the exception of 2023 and moving into this year, net margins are pretty consistent around the mid to high teens range. Again, something that we also like to see. From a relative valuation perspective, it's very, very cheap right now. So it's trading at a 7.5 times forward-looking price to earnings relative to its 5-year average of 7.5 times. Its price to book value is 2.2. You're only paying a price to sales of about 1 times. And so, we still hold it for our clients. We like the business. We like the really consistency of the business, with the exception of last year. And certainly they have had some earnings downgrades earlier in the year. I'm pulling up my earnings upgrades right now on this other screen. And starting in about January, or actually February, is when earnings started to get upgraded. They made $9.66 this year, or last year. They're projecting to make $25.21 next year. Their cash flow, although it started to taper off a little bit, was improving from 2021 to 2023. And so overall, we like this business. We think that it's at a relatively fair valuation right now. It's trading at about $156. So overall, we have to give it a thumbs up still. We still hold it for our clients. Probably going to see a little period of consolidation and then hopefully another leg upward. Now, the next InvestTalk, we'll look into this story. Social Security's COLA 2025 retirees face challenges. That's tomorrow, but for now, I'm Luke Guerrero, and we're ready to take your calls live on 888-99-CHART.
Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Hey, Luke and Justin, Bill from Philadelphia. Question with regards to bonds and treasuries. In your opinion, is now a good time to start dabbling and picking up some bonds or treasuries with their yields right now at, say, 5%? And the second part to that, if I do purchase, say, a 5 to 7 year bond or treasury that has a coupon of 5%, does it lock in at that 5% for that 5 to 7 years, or does inflation or interest rates affect that 5%? Just want to get some fixed income going and want to lock something in relatively short term. Thanks a lot.
Yeah, so the first part of that question is now a good time to invest in bonds, corporate bonds, and treasuries? And I would answer that by saying it's always a good time to invest in corporate bonds and treasuries if what you're looking for is genuinely capital preservation or income, right? A defined stream of income for liability matching, whatever. It could be because you have some sort of debts that you're paying off that are very low interest rate, and you want to guarantee that you have matching cash flow for those liabilities at a certain time. It could be that you want to get out of the market for a little bit, and you think that moving into shorter term treasuries just for a short period of time is something you need to do. Or maybe you have a big purchase on the horizon. You can't let that cash you can't let that capital be devalued. You can't lose money. And so you want to be in something safer that can still give you a little bit of income, whatever. Now, the next part of that question is about if you lock in a coupon rate, right? You buy a bond that's a 5% coupon rate, and interest rates move. What happens to the coupon? Well, if it's a fixed rate bond and it's a fixed 5% rate, because there are fixed rate bonds and there are floating rate bonds, but if it's a fixed rate bond, then that bond is tied to that covenant. You're going to get that 5% no matter what. Now, it could be a variable floating rate bond. There could be all sorts of other things within that covenant that may change that interest rate, but a plain vanilla fixed rate bond Whatever the coupon rate is, regardless of where interest rates move, that's what you're going to get. Now, the last thing I want to address is you said you were interested in 5 to 7 year bonds. I would probably move a little bit shorter in terms of term. I would probably move to the 0 to 1 year, maybe 0 to 2 years, and continue to recycle those. Just given that the rates are going to probably in the medium term move upward. Now, in the short term, they may move down, but in the medium term, they may begin to move upward as well. So I wouldn't go into the extended term area of bonds. I would keep it on the shorter term, and keep in mind that sometimes bonds have a place in your portfolio. It just depends on your circumstances. Thanks for the call. Speaking of bonds, let's shift gears and talk about really a historic level of debt reissuances. And so U.S. companies have managed to reprice almost $400 billion of debt at lower interest rates this year. And a lot of that is because investors have strong demand for junk loans. And so this shift occurs even as the Federal Reserve maintains interest rates at a 23-year high. And in practice, these companies have benefited from interest reductions to the tune of essentially 2 rate cuts. And here's why. The $391 billion, the almost $400 billion that I mentioned, is over a quarter of the entire $1.34 trillion leverage loan market. So truly the scale of this is unprecedented. The current demand is primarily driven by investment vehicles that repackage risky loans and by fund managers, with significant portions of this year's issuances involving borrowers rolling over existing loans rather than issuing new debt ahead of any Fed rate cuts. Highly indebted companies in particular have found some relief as investors aim to get access to debt investments while new supply remains low. Why would you issue new debt if you think that in the next 6 months rates are going to drop and you can issue new bonds or you can take new loans at lower interest rates, right? Now, among the notable transactions in this year's repricing wave, Cloud Software Group, the parent company of Citrix, successfully reduced borrowing costs on a $6.5 billion loan by 50 basis points. So that's what I'm talking about when I say by essentially 2 rate cuts. Similarly, healthcare company Medline decreased the spread on a $6.1 billion loan from 3 to 2.75 percentage points in March. So pretty significant for some of these companies. So how does this happen mechanically? Well, so repricings occur because leverage loans whose floating coupons are tied to U.S. interest rates makes them particularly attractive during times of rate fluctuation. So this demand has pushed the prices of existing loans to be above their face value, which means companies can negotiate lower borrowing costs. Currently, 39% of the junk loan market, 39% is priced at or above par, a significant drop from 65% in mid-May, but still astronomically higher than the 2.4% a year ago. It's really a paradox in a way, where the delayed start of the easing cycle has unexpectedly boosted inflows into bank loans, thereby increasing their prices and enhancing the economics of repricing for all of these borrowers. Now, the rise in demand has been driven by a surge in issuances of new CLOs, which purchase junk loans, that's collateralized loan obligations. They purchase junk loans, they repackage them, and essentially securitize them. And so you take the risky stuff, you take the less risky stuff, and you put it into a product that together is less risky than the sum of its parts. And so this issuance has doubled to $100 billion so far in 2024. It's the highest it's been since 2012. Despite the opportunities for many to reduce costs, though, this chance remains predominantly available to higher quality junk loan issuers. So the weakest borrowers are still being left behind. Now, even with the flurry of repricing deals, the overall interest expenses for loan issuers are still much higher than they were a few years ago due to the elevated interest rates. But reducing interest costs helps. It's not transformative enough to have a company's debt costs or fundamentally alter the financial trajectory of a company. But for a company that is one of those higher quality issuers of those junk loans, it will help. But even still, as I mentioned, for a lot of companies, this remains out of reach for them. So even with this available broadly to some participants, it's still important within your investment portfolios to focus on companies that have lower debts, because for them, high debt is still a pretty large burden. Now, here's another question that came into our InvestTalk YouTube channel, this one on AGCL. It says, do you think AGCL is a good buy and hold for the long run? Now, having trouble finding this name on FactSet. Well, I don't know if it's a good buy and hold for the long run because nothing is coming up when I type in ticker AGCL. So hopefully we'll get back to that question another time. Looks like I can't get to that one right now. So let's play another caller question that came into 888-99 chart.
Hi, Justin and Luke. I was calling in with a question regarding the stock GE Vernova. It is a spinoff from GE, and I've held GE for a while, and then it split off into 3 different companies. So just wanted to see what your thoughts are. The symbol is GEV. So wanted to see what your opinion is on whether to continue to hold or is there better opportunities elsewhere. So I'll be listening to the answer on your podcast. Thanks so much.
Yeah, so GE recently spun off a couple divisions. GE Vernova is the electrical power industry. It's in the electrical power industry. So its products and services generate, transfer, orchestrate, convert, and store electricity. I might say one thing that's going to be very important moving forward as you transition towards renewable energies, and one of the things that is actually the hindrance of doing it more quickly, is storing energy. So in terms of what needs to happen to necessitate transition, this is certainly a good business line to be in. Also, think about the cost of Bitcoin mining and cryptocurrency mining. And again, storing and moving energy, very, very important. Now, even though they've been trading for, looks like about 2 months now. Yeah, just over 2 months. We still have a financial history going back to 2021 at least. So their revenue in 2021 was $33 billion. And then their revenue last year was $33 billion as well. And this year they're projected to have a revenue of $34 billion. Now they're a $49 billion market cap company, so certainly large. And their margins are not great. They're not making money. Negative 1.9% in 2021. Negative 9.2% in 2022, negative 1.3% last year. Projected to make money this year. However, it looks like in June of 2024, they actually started making money. So they are making money already in terms of their estimate is to make money this quarter. So it'll be interesting to see when earnings get released on July 24th, if they are actually net positive in terms of income. Now, that being said, I think when spinoffs happen, you typically have a flurry of investment activity because people want to get exposure to a specific group within a company that they weren't able to siphon off a little bit. And you shouldn't look at spinoffs as if it's because a company thinks that that division isn't benefiting the company as a whole. With a lot of these companies, especially with General Electric, you have it with Procter & Gamble, you have it with a lot of companies, you had it with Dow Chemical, right? Where the business itself gets very large. And you essentially have some divisions that are operating outside of a cohesive structure within the business, such that all of these things operating together is a drag on what their individual value could be separately. So that seems to be what was happening here. Now, for me, again, it's trading at a forward-looking earnings of 40 times its estimate, which is a little high for me. A lot of this could be related to the recent spinoff activity again. But for now, honestly, I wouldn't buy more of it. I wouldn't sell it. I'd be interested to see what their earnings release looks like in July of this year. So that's 1 month away. So I would say hold on to it for now. Take a look at what their earnings release looks like next month, what their guidance looks like going forward, and then maybe call back. We'll take a look at it again. Thanks for the call. Now we're on a roll, so let's keep it moving and play another listener question from 888-99 chart.
Long-time caller here, and I love your show. I have a quick question. I know you've been recommending, and it's always a good thing to take your stock losses and stuff for tax reasons at the end of the year. To take the stock losses, I also know you need the whitewash rule for 31 days before you can buy them back again. How big of a loss do you need to have in a stock before you should take it? If you only have a stock loss and it's 400, 500, 600, is it worth doing that and then buying the stock back again? Or should you only do this if you have a loss of 2,000, 3,000, 4,000 or more? Is there a set amount that's kind of recommended? And then again, is this just for long-term holding stocks of 1 year or longer, or should you even do this for short-term held stocks, maybe like for 4, 5, 6, 7 months or so? Just wondering more specific details on this sale rule to capture your losses for taxes. Thank you guys for your help. Look forward to hearing your answers on your podcast.
Yeah, so the question is about selling stocks in order to harvest losses. And you see a lot of that towards the end of the year, towards the end of the taxable year. And one thing that the caller correctly noted is it's called the wash sale rule, which is you can't hold that instrument or a like security, a similar security, for the next 31 days, right? Or else the tax basis does not reset. It's like it never happened. It's called a wash sale. And so when should you do it? That's an interesting question. I've actually never thought about an exact dollar value of when you should do it, but let's think about what is happening when you sell a stock, why you sell that stock at a loss, and then eventually buy it back. Because sometimes you sell your losses and you want to get out of the position entirely. Now, if you want to get out of the position, that's a reason why there shouldn't really be a dollar value ascribed to, okay, this is enough loss for me to get out of this position, right? You should already have an idea of what that is when you buy a position, what your target band is, what your loss tolerance is for that position. And it shouldn't really be tax related, right? It should be capital preservation. Now, if you are just selling stocks that you're going to buy back, right, just for tax loss harvesting, I would argue that it's actually less important how much losses you're realizing. Because at the end of the day, this is an aggregation, right? So any losses are good losses. I think what's more important is, does the momentum, does the technical factors, does what is going on within the business over the next 31 days make you believe that you're going to have to buy back into this stock at a higher price, right? Because yes, we like offsetting our gains and with losses and all those things, but you don't want to leave and then enter a position in an actual worse dollar value amount than you were before. So the names that you should be harvesting those losses are, again, the ones that you are just going to exit out of entirely. That's the first part. But also the ones that you think within the next 31 days, they're not going to move heavily against you. Then you have to buy back at a way higher price, making it far less worth it to harvest those losses in the first place. Thanks for the call. This is InvestTalk. Now with wait for it, over 59 million downloads. And that's not because of me, it's not because of Justin, that's because of you. I'm Luke Guerrero, and we have one goal here, that's to help you achieve your financial freedom. And our work continues after this break, so get your caller questions in now at 888-99-CHART. You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
I have a question on a ticker, ARCC. It is a business development company, and I am looking at it, and I'm very interested. I would like to know what you think about it. Have a wonderful day. Bye-bye.
So Ares Capital is a business development company, and so they structure products that help finance businesses. And it's well run. It's at a pretty consistently high yield. This may be, I believe, why you are interested in it. It yields anywhere between 8 and 10% over the past 5 years. It's consistently raised its dividend over the past 5 years as well, with the exception of 2020, where its dividend was flat. But other than that, it's increased its dividend anywhere from 1 to 6 cents consistently every year. And so, I think for me, one issue that I have here is in terms of its growth It's kind of dried up a little bit in the past couple of years. It's been sitting around 2 billion, 2.4 billion in terms of revenue. So the growth is drying up a little bit. That's one concern that I have. Another is margins have been slipping a little bit as well. And so you take a look at their net margin, and it slipped down to about 27%, which sounds great. You look at this at 74% in 2021. Finance companies, this industry, have incredibly high margins. And so it's rebounding. It's back down to about 50% where it was back in 2018. So maybe that's a little mean reversion. Now, it looks cheap. It's traded at a forward-looking PDE of 9, trading at a price to book of 1.1, but that's typically where business development companies are trading. Its price to cash flow 12 times, a little bit more expensive than its other metrics look. Its cash flow has been increasing a little bit over the past 3 years. That's certainly good. It has a lot of debt, but BDCs tend to have a lot of debt. It also issues a lot of shares, which a lot of these companies tend to do as well, something that I don't really like as much. Either way, I would expect over the next probably short to medium term, over the next 6 months to a year, 6 months to 2 years, that business development companies don't do as well as they did pre-pandemic. I don't think those margins are ever going to go back to that 74%, that 65%. And so if you're looking for a company that can pay a consistent dividend yield around 8 to 10%, it's not paying this dividend yield because it's in distress. It's up 12% over the past year. The company is fine financially. They're not overly levered relative to other businesses within this industry. I think this is a fine name. Just know that some of the growth has really dried up. And in terms of where we are in the economic cycle, I don't see a lot of upside over the next 6 months. Thanks for the call. Now, before we head off for the day, I wanted to briefly touch on an interesting story, and that is Interactive Broker Group is set to launch a new trading platform called ForecastX on July 8th, which allows customers to bet on economic and climate events through yes or no contracts. Now, these contracts will cover various indicators like the Federal Reserve's target interest rate, U.S. consumer sentiment, atmospheric carbon dioxide levels, and it was approved by the CFTC, the Commodities Future Trading Commission, and won't deal with securities, but rather a new type of derivative focused on event outcomes. And so essentially, it's like what political betting markets used to be, where you could buy sides for cents and the eventual correct outcome is valued at $1. So unlikely outcomes are going to be, lower, closer to zero. More likely outcomes are going to be priced closer to $1. Now, I have mixed feelings about this. I think that generally over the past 10 years, investing has moved towards gambling in a way that is unhealthy for retail investors and a bad lesson for retail investors. So on one side of this, making economic forecasting more like gambling probably is in the long term going to hurt the psychological reasons people have for investing in companies, right? That's one thing. But on the other side of it, I think it could be interesting. I think that in a way, this is another form of price discovery, right? This is another market that is being made. And so when you are thinking about the macroeconomic environment, when you're thinking about the jobs numbers, you can see what other people are saying. So, it's an interesting thing. I don't recommend going on there and gambling. I'm not a big gambler myself. I'm not endorsing gambling. I just thought I'd bring it up for everybody because, hey, it's interesting and that's what we do here. Now, I'm Luke Guerrero, and this completes another episode of InvestTalk. Justin and I thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads, as well as our InvestTalk YouTube channel. That's InvestTalk with 2 T's. If you want to come look at the charts that we saw today or any other day, I think it's interesting. I love it. I think you'll love it too. So feel free to stop on over there, leave a comment in our comment section if you want to get your question answered. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.